Hi, everyone. Thanks for tuning in to another episode of CFB Talks Digital Assets. We have a particularly special episode for you this time. We're joined by the CEO of CF Benchmarks, Sui Chung, as well as myself, Ken, and Gabe, head of the lead research analyst. Obviously, we have Sui Chung on the episode this time because of the FTX situation. Sui has written a blog post which has been getting quite a lot of traction. We thought we'd talk about it. Essentially, within the blog post, Sui talks about the FTX debacle, but also the potential impact on regulation. Sui, would you perhaps give us a bit of a synopsis of what you wrote?
Yeah, of course, Ken. And firstly, thank you very much for having me on. It's really great to join you guys for this chat. In essence, what I believe is going to happen in light of the FTX situation is that it's going to accelerate regulatory scrutiny, accelerate regulatory implementation of regulations for the crypto service provider community. So often what people term as the crypto industry. I think it will precipitate further regulation, and that regulation will give everybody, not just those engaged in providing services for crypto underlying assets, digital assets today, but it will give regulatory clarity to all the requirements that governments will seek from service providers in the sector. And that includes, of course, institutions that are not engaged in providing services against crypto assets, digital assets today. And so that means it gives the regulatory clarity and the rules of the road for particularly the traditional financial institutions who have thus far only engaged in very limited numbers. But when that regulatory clarity comes, that is really the starting gun for institutions, traditional financial institutions engaging in the space.
So I mean, just to frame it a little bit better for people, I think what you were trying to say was rather than FTX explosion, Alameda, malfeasance, essentially putting off people, including institutions, from the crypto space. Rather, you were seeing the possibility that regulators would likely step in, accelerate any plans that they had going on, and that would be an attractor rather than sort of like a demotivator of institutional adoption. Is that pretty much it?
Yeah, I think that's pretty much in a nutshell, Ken. Thanks for that. Because to date, the number one impediment for traditional financial institutions to engage with the digital asset class is regulation, or rather the lack of it. The lack of regulatory clarity has been a big impediment. And once that regulatory clarity comes in the form of regulation, in the form of legislation and regulation, then that really does open the potential floodgates, and as I said, would be the starting gun for traditional assets, traditional financial institutions to start engaging with the asset class.
Yes, and Gabe, we were talking about this just before we started recording, but you had a really quite a salient, perspicacious question regarding that. Could you just sort of like refresh our memories on that?
Yeah, absolutely. Hey, thanks, Sui, for jumping on the podcast with us. So when we think about the crypto community at large, the term regulation with them is a bit like water and oil. So when we're talking about what we're seeing as far as potential future safeguards or regulatory improvements to help this institutional adoption trend, what do you think that's going to look like? What areas specifically do you think need to be regulated?
That's a really good question, Gabe. And I think that the whole term, actually the term crypto industry is not very helpful, right? And in a sense, it's part of the problem because the crypto adoption, digital asset adoption, and the service providers the providers who engage in the services, providing the services, have grown very, very quickly in a very short space of time. And so, 4 years ago, when CF benchmarks first began, the crypto industry was pretty simple. It was exchanges, right? It was Coinbase, Kraken, Gemini, Binance, a few others who offered the facility for users to trade, to swap one asset, be that it could be a fiat asset, it could be a digital asset, for another digital asset, right? So trading through a central limit order book. Now, and that activity, and millions of users flocked to those exchanges, and that activity really, the regulators, when they saw that activity, the first thing law enforcement regulators saw was the potential to impact the integrity of AML, KYC, and counterterrorism financing regulations and laws. And so, very quickly, they mandated AML, KYC policies from crypto exchanges. Now, that today in the major jurisdictions is pretty much a sine non qua, is pretty well established that crypto exchanges have those policies and processes in place. It's not 100%, because obviously there are offshore-based exchanges for whom the oversight of their implementation of such regulations is potentially questionable. And certainly I don't think I'm breaking any official secrets acts here when I say that exchanges based in the US, in Europe, are having to meet a higher standard and have greater regulatory oversight put upon them for ensuring that they enforce AML, KYC regulations. So that was crypto 2018, 2019, 2020. But you fast forward to 2022, you have a plethora of services being provided. Services that look a lot like banking, for instance. So we've seen that Celsius, to a degree, Voyager Digital, now Genesis Global Trading, these firms who were engaged in taking users' funds, promising them a return, a yield, and generating that yield by effectively lending that crypto out. So effectively banking sure. Services. And you have all manner of services in between as well. And I think that the first thing about regulation, that any potential regulation, is it's got to be very clear that it's the activity, it's the underlying activity, and its potential for increasing risks in the economy, risks both in the digital economy, digital asset economy, and in the traditional economy, systemic risks. Running a central limit order book so that people can exchange assets does not create systemic risks. Taking people's assets, lending them to people with shoddy or non-existent risk management practices obviously creates risks, as we saw in the 2008, 2009 financial crisis. And then at the very extreme end, such as FTX, where you are purporting to be an exchange, where users leave their funds on the exchange purely for you to safekeep until they wish to trade them for other assets, saying that's what you do, when in actual fact you're engaged in lending to third parties and related parties. Right? Let's not forget that the vast majority of the funds that FTX fraudulently, because on the terms of use for FTX, let's be honest, it's fraud. Yep. On the terms of use, FTX's terms of use says we don't use your funds for any other purposes other than to safekeep them until you want to trade them. They took those funds, lent them to a sister company, a related party who share an ultimate controller, ultimate beneficial owner. That is the most extreme end, and I think that I hope that regulators will come in and firstly see that number one, in the case of FTX, if people wish to act fraudulently and wish to wantonly break the law, then no amount of regulation is going to stop them. There is a question around how effective your enforcement of regulations is. So you might catch it sooner, but quite frankly, you can't actually. No regulation is going to stop that happening. You might catch them sooner. It might dissuade them. Being in a harsher legal climate, law enforcement climate might dissuade them from doing that, but you can't stop that. Then there's the piece, around just the banking-like services. I think that any form of banking-like services is very likely to face serious regulatory scrutiny. Regulators may very well seek to regulate that activity very heavily, just as they do the traditional banking sector. And we may see, in fact, prudential regulation come in for that sort of activity, i.e., capital adequacy assessments, capital reserve requirements, et cetera, just as we see in the traditional banking sector. And it's not beyond the realms of possibility that we see the ultimate form of prudential regulation for that sort of activity, which is just the prohibition of providing that service if you are providing any other types of services. Just as we could see a sort of crypto Glass-Steagall. Right, Glass-Steagall, famously in the 30s in the US, which prohibited any deposit-taking institution from engaging in securities activities. Right? Just a no, just a hard no. If you do that, you can't do the other. The Volcker rule is a form of prudential regulation saying that if you are a financial institution, if you are a bank with access to the Fed discount window, you will not engage in proprietary trading. So we may see in certain jurisdictions that sort of stipulation come in.
Thank you very much for that, Sui. That was really interesting and insightful, a good roundup of the entire situation for the industry. One really pertinent question, which I think a lot of people would know, I'm certainly interested in. Are you actually saying this will have an impact on institutional adoption going forward in the medium to long term?
Yes, I think I am, because it's accelerating that action from regulators and governments. The FTX situation is going to accelerate any plans they had to regulate. It's going to make very clear what the priorities for regulation are, which activities that are being provided require further regulation, which, as we've seen from the resilience of some of the more established players like the Coinbase and the Krakens with the quite frankly, simpler business models, less risky business models, where there's less that needs doing. And for those where it's highly opaque, where there's more risk being created, that's where more regulation is needed. And that clarity will mean it will become a lot clearer to banks, to asset managers, to different traditional financial institutions, what role they can play, and from a value add perspective, but also from a regulatory perspective, which regulations are they comfortable abiding by, that they are set up to be able to abide by. And I think that's very important in terms of not only bringing more capital, more resources to the digital asset class, but also bringing the distribution capability of those traditional financial providers so that more investors, mom and pop investors, from mom and pop investors all the way to pension funds and all points in between, that these institutions do have the connectivity with today. They can bring those investors that are not yet engaged with digital assets to the digital asset class. And I think that's really going to be the big, the potentially big change that have been precipitated by FTX's collapse.
Sure. You and I have been around in markets in the City of London. We're in the UK for some time, and we've seen the development of regulation over different asset classes. This is going to be pretty much an impossible question to ask, but there's no better person to ask it than yourself in this room. How long do you think we're going to see that take for that regulatory clarity to materialize?
I actually don't think it's going to take very long at all, because FTX was so high profile, particularly in the US. It had a very high political profile. It had a very high profile amongst lawmakers, amongst regulators. Sam Bankman-Fried had testified before Congress. He'd spun the political leadership of the U.S. this notion that that regulation should be of a certain type. Largely, most casual observers, most disinterested observers would say favored FTX effectively, and that has meant that this is very much a hot topic on the Hill in the US because of Sam Bankman-Fried's profile, his political donations. This is a man who has donated in excess of $35 million just for the midterm elections that have recently passed, predominantly to the Democratic side of the aisle. So because of all those things, I think that we're going to see this sooner rather than later. That not only must something be done, but something must be seen to be done.
Sure. Now, if we can sort of broaden things out a little bit, there is a bit of extra news, additional news, follow-on news to the FTX situation related to contagion, of course. And I guess the main topic of that is a particularly prominent financial group within the crypto industry, the Digital Capital Group and its companies, particularly, of course, the Grayscale Bitcoin Trust, additionally the liquidity provider Genesis. Now, I know that there's a bit of talk. We have to be really cautious and really careful, but there is a little bit of talk and a little bit of discussion in the Twitter sphere and also in the press about the solvency of Genesis. I wonder whether we could sort of get your take on that, Gabe.
So, yeah, what's going on with DCG and Genesis is just another example, really, of how this is having potential spillover effects and liquidity crunches. So it was reported that they're needing to fundraise approximately, let's say, about $1 billion over these next few days before, they potentially will face a bankruptcy. So again, I think what we've been talking about throughout this podcast really is just kind of the same theme. And it's about what's going to kind of give a kick in the pants for regulators to start, considering some serious options to put some guardrails in place in the industry, which is what Sui's been talking about. And what that's really going to bring, I think, is more confidence. So it's confidence on the institutional side. It's confidence to where if I'm an asset allocator, if I'm running an asset management shop and I'm considering putting, a Bitcoin fund or some sort of crypto fund on my platform, I'm going to have more confidence in selling this product to my customers, exposing my clients' monies to these types of funds and these products. And so it's kind of like the same flavor of what was happening with FTX in a sense, in a smaller scale, because there wasn't maybe so much outright explicit potential fraud that we're seeing as more news comes around involving FTX. But it's still this idea of these this contagion, this liquidity crunch, which is kind of spiraled from the FTT token that was on Alameda's balance sheet, which triggered these withdrawals, which created that death spiral for FTX.
Sure, we're seeing some exposure, some FTX-like exposure without perhaps the malfeasance, in all probability without the malfeasance.
That's very typical,
the same impact
right?
on consumers due to the lack of certain controls.
But it's very typical whenever you have such a major player, which FTX International was, and all these subsidiaries, they really played a huge part of this ecosystem. So we should expect that this is going to continue to kind of take some time to shake out. But as we do, and what Sui is trying to, highlight with his blog posts is lay that kind of runway ahead about building that confidence, about building that clarity, so institutional investors can feel more comfortable getting back into the space or entering the space to begin with.
Sweet. I wanted to widen things and just maybe reach finally the DCG GBTC part, whereby we know that the discount to net asset value evinced by GBTC is now regularly over the last few days above 40%. What kind of should we be expecting to happen? I mean, I expect I expect my notion of GBTC, DCG in general, to be a well-run company running well-run, satellites to basically still hold true. But when a sort of fund reaches that level of discount to its asset value, it starts having impacts, certainly implied impacts that we're starting to see in the markets. What is the sort of escape route, in your view, from this situation for them?
Yeah, that's a great question, Ken. And as some who are some of your viewers may or may not know, some of the first waves of failures that we saw, particularly from the crypto neobanks like BlockFi, were actually caused by the GBTC discount, right? So there was the GBTC premium trade that we know that BlockFi was engaged in pretty heavily. As we've seen from their bankruptcy filings, they still hold a lot of GBTC, but as you rightly said, when the discount is north of 40, touching 50%, you just won't sell the shares, right? Selling the shares would crystallize such a devastating loss to the balance sheet that you wouldn't do that, and hence nobody is doing that, apart from the most desperate for liquidity. Trading at 50% discount to net asset value, which is, I personally just cannot think of a discount for a fund who that actually holds those underlying assets. I've never encountered a NAV discount of 50%. And the reason that NAV discount is there is that because of GBTC's odd structure, it's a closed-end fund, but i.e. there is a creation mechanism. You can create shares, you can give Grayscale your money, and they will give you shares. They will take your money, give you shares, and go out and buy Bitcoins with your money, put those Bitcoins in the fund. But there's no redemption. You can't give the shares back to them in exchange for either the Bitcoins that are inside the fund, nor can you give the shares back and say, oh, the Bitcoin is the Bitcoin, my Bitcoin entitlement is X, the price is Y, X times Y equals Z dollars. You can't do that either, and hence you have this discount. And and I think that structure is, because it's that's what the fund articles say, that's what it is. At the SEC, they have petitioned the SEC on a number of occasions to try and flip the structure into an ETF structure so you can have creation and redemption. It's been rejected. And where else is there for them to go? Well, the only option of actually available is to dissolve the fund. So if as the manager and the trustees, the board of the trust, decide that in the interests of the fund holders, we should liquidate the fund and give everyone their money back, i.e. take the Bitcoin, sell them, and give everyone the proceeds back, or they can take the proceeds in Bitcoin. That is the only way out. But by doing that, GBTC, Grayscale, by doing that with GBTC, Grayscale would be foregoing the management fee forever. They would be effectively killing their own golden goose. That's the dilemma they face. Not a very pleasant one. But also an interesting sort of second order effect of this is that GBTC is actually acting as a pretty strong anchor for the Bitcoin price, because there's I think it holds a couple of million Bitcoins. No, maybe that's too high. A couple 100,000 Bitcoins. And of course, those Bitcoins are sort of stuck. They're locked into the fund. They cannot be sold. So there's a very large chunk of Bitcoin that will certainly not hit the market. And that is acting as a little bit of an anchor for the Bitcoin price. And I think, to be fair to the management of Grayscale, they have, I think that that is a non-zero consideration, that potentially by winding down GBTC, they would be potentially unleashing a lot of Bitcoin onto the open market that could make its way to be sold, and hence that would put further pressure on an already very pressurized asset class and sector. So, yeah, a lot of things for them to balance out. I don't envy them, but fundamentally the structure is a very challenging one.
Sure. Yeah, there are a lot of follow-on succeeding issues following on from this massive debacle that the industry has seen. The discussion could go on for a very long time. In fact, it will go on for a very long time. Unfortunately, our time this afternoon is over. I really appreciate you, Sui Chung, for joining us, and of course, Gabe, for being with us as well. And of course, for you guys for listening in too. Hopefully, we'll see you again soon. Thank you very much indeed for listening to CFB Talks Digital Assets.
Thank you.
Thank you. See you.